Picture a Washington family thrilled to inherit their parents' Seattle home and hard-earned savings, only to be blindsided by a $50,000 tax bill they never planned for. That's the reality of Washington's estate tax, which kicks in at just $2.193 million. In today's episode, Taxes and Estate Planning, What You Need to Know, I'm sharing how to protect your legacy, whether it's a cabin in Clayton or a nest egg for your kids, from unexpected taxes, from trusts to simple gifting tricks. Stick with me to keep your assets where they belong, with your loved ones and not the taxman in Olympia.
You are listening to the Legacy Talk podcast hosted by James A. Jones,
attorney at law and founder of Sound Legacy Law, PLLC in Tacoma.
Attorney Jones is here to talk about how to best protect your family, assets, and wealth, pulling stories from his more than 20 years of helping families and business owners protect their assets, create their estate plans, preserve their wealth, and plan for the future. Nobody wants to think about estate planning, but life has a way of sneaking up on you, and at any moment, something unexpected could happen that will leave you regretting not having acted sooner. So join Attorney James A. Jones in the Legacy Talk podcast, and together learn how to plan for your future today and have peace of mind tomorrow.
Welcome to Legacy Talk. I am your host, James Jones. In today's episode, we are talking about taxes and estate planning, what you need to know. It's all about death and taxes, right? That's what life's all about. Not really. While estate taxes are not a sexy topic to talk about, it is a topic that matters to most families in Washington. Most of the clients that I work with have an estate tax issue or they are close to having one. Most clients I meet say something like the following: I just need a simple will. My estate's not very big. It's not complicated. But the truth about this is when you consider your house, your life insurance, your retirement plan, most Washington families have a taxable estate or they're very close to it, right? I've had lots of clients lose thousands of dollars on estate tax that they didn't need to, had they planned properly in advance. That's why today's topic is so important. You can't plan for what you don't know. So today we're going to go through 8 or 9 or 10 talking points regarding the Washington state estate tax and estate tax in general, so that you know what to look for, what to consider when you're doing your estate plan. So to start off with Washington's estate tax, we're one of the only states in the country that has its own estate tax. There's maybe 10 of them, maybe not even that many. And we're one of the lucky few to have our own estate tax. And Washington's estate tax exemption, which is the amount that can pass without going over and having to pay taxes, $2.193 million. That's the inflation-adjusted amount currently in 2025. It goes up very, very, very slow. It started at $2 million several years ago, and it's only at 2.193 now. So the rates on this tax are 10 to 20%. It's a graduated rate. And unlike the higher federal rate, which we'll talk about, this affects the vast majority of middle-class families in Washington. If you have a house, if you have a retirement account, if you have life insurance, based on the values of real estate and the stock market lately, and people that have been working and saving, you're probably going to have an estate that's subject to estate tax or very close. So picture, this is a scenario, right? You have a house worth $1.2 million. You have $800,000 in a retirement account or investments. And you have a $500,000 life policy. You may not even know you have a $500,000 life policy because it's given by your employer or something like that. If you have that estate, you could owe estate taxes, which reduces what your heirs would receive. And you might not even know about it, right? So first actionable tip today that we're talking about is do your math, right? What's your estate worth? What's the net estate worth? Take your house minus the mortgage, take your retirement savings, take your bank accounts, life insurance, and see what it's worth. Where do you fall in that, exemption amount? So 2.193 million is what we're looking for. And if you're anywhere near that, you need to plan for it. Okay? Now, the federal exemption is much different. The current federal exemption is $13.9 million or change per person in 2025. This is not set in stone. As with many, and I guess all probably, taxes at the federal level, they're subject to sunset provisions or being overturned by other taxes. This one in particular is subject to a sunset provision that expires at the end of this year, 2025. And it's scheduled to drop to about $7 million per person in 2026, unless it's extended by Congress. And so if your estate's over $7 million or in that range, then you're also thinking about federal estate tax. And so right now, if you have a very large estate in Washington, you can gift almost $30 million without paying estate tax, and do that before it shrinks. Over the years, I've had many clients give large portions of their estate. There was one year, 10 or so years ago, 15 years ago, where there was no estate tax for a year. So we had a lot of clients that sort of took advantage of that, but no gift tax, I should say, or estate tax. And they took advantage of that and made some gifts and saved some money along that. So if you start gifting now, you can save money and beat the deadline. And the good thing about that gifting idea is while Washington has an estate tax, the federal government has a gift tax and an estate tax that are tied together, which is all tied about $13.9 million mark. And so you can gift quite a bit of money at the federal level. Washington does not have a gift tax. So we don't tax lifetime gifts here. So you can make unlimited gifts and reduce the taxable estate that you have. It's not always great to gift. There's issues to consider like basis and taxation other ways if you make gifts. For example, if you gift a piece of property that you bought for $100,000 but now is worth $500,000, the person receiving that gift receives that property, and if they sold it, they would be taxed on the difference between $100,000 and $500,000 rather than if they inherited it, where they would be gifted or taxed on the amount that it's worth at the time of the inheritance. So there's capital gains there, which may sometimes, in some cases, are higher than the Washington state estate tax. So if you gift things, maybe make it cash, maybe make it things that have more fixed values and instead of basis, which is a whole other topic which we're not going to talk about because it's complicated and boring. So, but for example, you could make a plan where you gift like $50,000 a year, to kids over 5 years, reducing your estate by, a significant amount and reducing your estate taxes by correspondingly significant amount. There's a new rule in Washington, which isn't really that important. It doesn't matter that much. So when married couple, the surviving first spouse dies, the surviving spouse has what's called an unlimited marital deduction. There is a new rule where if your primary residence is incorporated in your taxable estate and that puts you over the 2.193 million, you don't have to include the primary residence in determining whether you have to pay the tax, or not pay the tax, but file the tax return. You're not paying the tax because there's an unlimited marital deduction. So it's really kind of a moot point, but it does save time and it does save money, because one of the reasons that you want to avoid estate tax in Washington is because you don't want to have to file that stupid return. It's a bear. It's something that is not something that can be done like online as well as like a regular federal return. And then for the most part, these returns are audited, each one. And so it's difficult to, just filing the return costs a lot of money and time and hassle. And so if you don't have to file, that's good. So does the Washington state estate tax affect non-residents of Washington? Well, James, why would we worry about that? I don't live in Washington. Why would I worry about estate tax in Washington? Well, you would if you owned a piece of real estate in Washington. And so say you've got a cabin, you might live in California where they don't have an estate tax, surprisingly, shockingly almost, but you've got a cabin up here. And if that cabin is of significant value, you could be paying tax on it. And so the other interesting caveat, and I'm not sure how this will be ever enforced or determined, I don't know. Washington looks at the worldwide gross estate of a non-resident in determining whether they have to file a return or whether they're taxable. So in some scenario, you could say, well, a California resident had a $3 million estate, which included a $1 million Washington house. Even though the $1 million Washington asset is below the 2.193, they would still tax that at 10%. I haven't ever seen any cases like this. I don't know if it's been challenged. It's something to consider. And if you're a non-resident, you're probably not listening to this podcast, but it's something to consider if you have a taxable estate in another state, or a large estate in another state if you have a house here. So maybe holding it in a different kind of entity might make sense. Or moving it out of Washington and buying it in another state that doesn't have taxes. So how do we save these taxes? One way is to use an irrevocable trust. These are trusts that you can create and gift to during your lifetime. You can remove assets from your taxable estate, avoiding this 10 to 20% estate tax. It also avoids federal taxes. And so if you have an estate over 2.193 million and have appreciating assets like a business or real estate or stock accounts or whatever, you can make gifts to an irrevocable trust where they would grow tax-free. And in certain situations, you could maintain control over these assets. But it's not something you're going to try to do on your own. It's not something that everybody is going to do, and most people aren't going to do it. Okay, most people with regular estates don't need to do something that drastic, which means give your stuff away for someone else to manage just to reduce estate tax. That's not something you definitely need to do if you're, an average person with a smaller estate, which means probably under 5 or 10 million. Okay. Another thing that's different and interesting and important to know with regard to Washington's estate tax is that it's not portable. So the federal estate tax says, hey, I'm going to use my spouse's credit for mine when I die later. Okay, I'm not going to do anything about it now, but when I die, I'm going to use my spouse's credit too. So I'm going to have $28 million or something. Okay. Washington's estate tax is not portable, which means if you die and don't shelter your exemption in Washington, your spouse can't come back later and say, well, with their $4 million estate, for example, say they have a $4 million estate. They can't come back and say, well, what about my spouse's exemption? Can't we use that? That was half of hers or his. And Washington's going to say, no, nope, sorry, you are out. That's what they'll say. Exactly like that. So the solution is to shelter the credit for the deceased spouse. So we call that a credit shelter trust. This can be set up in a will or a trust. Usually I do them in a revocable trust as part of a revocable trust. But a credit shelter trust is a trust that can preserve the first spouse's exemption, ensuring that both $2.193 million exemptions are used or available. So basically for a married couple in Washington, it's about $4.4 million or so, right? If you shelter the credit, okay, if you do it right. If you don't, you're gonna be in trouble, okay? So if you don't have a credit shelter trust, and if you don't have, but you do have a taxable estate, then you've got to do something about it, right? You've got to plan for it. And so it saves a lot of money, right? So say, for example, you had a $4 million estate, like we said in this scenario, and you put $2 million of it, when the first spouse dies, you put $2 million of it in a credit shelter trust, and then the surviving spouse dies with $2 million, which is less than 2.1, right? They don't have to pay estate tax. But if they didn't shelter that first spouse's credit, then they're going to die with a $4 million estate, so they're going to pay tax on about $2 million, which is a chunk of change. And so that's the big savings, okay? So how do we reduce the estate tax if we're not willing to gift everything away or use a shelter trust, or I don't have anybody to gift to? You can deduct certain things like funeral expenses, estate administration fees, you can deduct debts that are paid. You can also deduct charitable bequests. So if you give a large sum of money to charities, those reduce the taxable estate that you have or the estate value you have dollar for dollar. So charitable giving is a good thing. So donating, say, $300,000 to a nonprofit in Washington via your will can reduce your taxable estate by that amount, right? And you can still support those you want to support and love and help. Now, this is a current bill, I guess, is close. They're always talking about increasing the exemption in Washington to $3 million, and then maybe increasing the rate later, the higher rate, over $10 million rate. I'm not sure that's going to happen. But as far as estate taxes go, it's easy to get around it if you have a normal estate. Even up to 4 or 5 million, it's pretty easy to get around 6 million. If you're much larger, there's other tactics and tools that we use to reduce the value of your estate, which are better usually than just putting everything in an irrevocable trust or gifting it to your kids, because we don't want to do that in most cases. So proactive planning, allowing you to plan your gifts. Are we making any gifts? Are we going to do charitable bequests when we pass? Or creating entities so we can move stuff around is better than just haphazardly doing it. And working with an experienced estate attorney is important for that. But, like everything, tax laws change, right? So we want to make sure you're looking at this regularly. And if you're hearing things about things going on in the legislature, take a look, right? Or call your lawyer, right? Call me. We don't want to have Olympia decide how much we're paying, if we can plan for it. Okay. Now, estate planning in general, but James, I don't have anything set up. Well, if you have a taxable estate or you're close to it, you really need to do it, right? You really need to do it. I usually say that if your estate's like $1.5 million or so, you should put tax planning in, because in no time you're going to be over 2, right? With real estate values going up, your investments going up, other things like that, you're going to be on the precipice of paying estate tax. So estate tax planning, if you're in the $1.5 million or higher range, is pretty smart. And so you want to make sure you know what your life insurance pays out, right? How much is your house? How much is your mortgage to the house? What do you have in your 401k or your IRAs or your investment accounts? So you want to meet with your lawyer to go over all this stuff. At least start something, right? You don't have to have a full-blown revocable trust plan to have estate tax planning, or to have an estate plan in general. You don't have to have some full-blown plan. But it's important to consult with someone that knows what they're talking about, right? And so, this is an important topic that is not necessarily interesting. It's not something that people are thinking about for the most part, just because they don't know. But estate taxes are a thing, and Washington has one of the most relevant things in the country with regard to estate tax. Be happy you're not in Oregon, because their exemption is only $1 million. So imagine that. That's insanity. So that's it, though, for today's episode. So think about your estate. If you have questions, let me know. Next week, we will be talking about blended families and estate planning challenges, because there are challenges with blended families that are not as simple as families with just one set of kids. Okay? But that's all for today's episode. I'd like to thank you for listening to today's episode of Legacy Talk. If you like today's episode and would like to learn more, please like and subscribe for more great content. I've been your host, James Jones. To your legacy.
Thank you for listening to the Legacy Talk podcast by attorney James A. Jones. If you found today's episode helpful, we ask that you like and follow us on all major platforms so you don't miss out on the latest episode. If you have questions for Attorney Jones, reach out at info@joneslegacylaw.com or visit our website at joneslegacylaw.com. Join us again next week for another episode of the Legacy Talk podcast.